Imagine a company so underestimated that a single day could flip its entire story not with hype, but with numbers so powerful they shake Wall Street's confidence. That company is AMC. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone, remember, this is not a financial advice video. Today, we're diving deep into what's really happening behind the scenes, from the massive $20 million difference in AMC's box office estimates to brokers facing breakdowns, hidden short positions being cornered, and why AMC's setup today mirrors the early stages of legendary short squeezes in financial history. Let's begin with what started this chain reaction: the unbelievable numbers. A $20 million gap between the estimated and actual figures isn't something the market sees every day. After the weekend, AMC reported $93 million in real box office numbers, an enormous leap. This isn't a small surprise, it's a statement. It proves how fast AMC's business is expanding and how its fourth quarter is setting up to outperform expectations yet again. The box office boom isn't just about a hit movie, it's about structural change. One of the biggest contributors to these staggering results is the Taylor Swift concert film, a release backed and distributed by AMC itself. Unlike typical movies, this one didn't just earn AMC ticket sales, it earned them distribution revenue too. That means more profit, more control, and a new revenue channel that traditional theaters rarely touch. When a company not only sells the product but also distributes it, margins rise dramatically. And that's exactly what AMC is doing, turning its structure from just a cinema chain into a multi-layered entertainment business. But let's think long-term for a second. Even if the box office doesn't skyrocket every quarter, AMC's efficiency upgrades, cost management, improved market structure, and smarter operations mean profit margins can keep expanding. So if both revenue and efficiency climb together, the upside compounds. Now, let's talk about accumulation, the quiet but powerful signal that big players are loading up. According to investor Stefan Vikstrom, it's only a matter of time before a heavyweight institution steps in to exploit the short sellers' over-leveraged positions. This isn't wishful thinking. It's based on patterns we've seen before, such as the Volkswagen short squeeze, a moment in history when two major institutions went head-to-head, causing one of the fastest and largest stock explosions ever recorded. We're seeing similar setups here. Institutional data shows that not only are firms holding AMC for the long term, but many previous short sellers have flipped their positions and gone long. The visible short interest, the part we can actually track, doesn't even tell the full story. Behind the curtain are synthetic shares, hidden shorts, and failed-to-deliver FTD obligations piling up. At some point, these will need to be settled, and when that happens, we'll see buying pressure like never before. So what's stopping it now? It's simple. The institutions on the long side haven't yet decided to pull the trigger. They're waiting. The moment one powerful entity decides it's done protecting others and moves to profit from the squeeze, it could create a domino effect that leaves short sellers in chaos. But here's the key. That's not the only path to AMC's rise. The company's fundamentals are aligning with a long-term recovery that stands on its own. AMC's leadership under Adam Aron is exploring multiple innovation fronts, including artificial intelligence. One of the major directions is using AI for film translation, making movies instantly available to global audiences in their native languages. This is massive because it breaks the traditional barriers of international distribution and opens new markets overnight. Combine that with the growing contrast between traditional theaters and digital streaming. We're seeing streaming platforms like Netflix cutting projects, canceling shows, and struggling with subscriber retention, while movie theaters are proving to be surprisingly resilient. The entertainment cycle is returning to the big screen experience, and AMC is positioning itself at the center of that comeback. Institutions see this. They see a company that survived the pandemic, stabilized its debt, diversified its revenue, and now operates more efficiently than ever. That's why, despite all the market manipulation and volatility, accumulation continues quietly behind the scenes. Now, here's where things get even more interesting. A recent reminder from Greenholder shows how quickly AMC can move, referencing its pre-split days when the stock surged nearly 95% in just one day. That's not speculation, that's history. AMC has already proven it can move violently upward. The problem? Every time it starts to climb, trading halts hit within minutes, sometimes after just a 30% rise. Meanwhile, other stocks have been allowed to skyrocket 1,000% or more in a single session without such restrictions. Why the difference? Because AMC's movement threatens a massive network of overleveraged short positions. Even a 50% move could trigger losses in the hundreds of millions for these hedge funds. That's why the system slows it down. They know what AMC can do, and they fear it. And yet, even with all that manipulation, AMC keeps improving. Retail investors, the so-called apes, haven't given up. They understand that this is not just about a company. It's about a movement, a direct challenge to the system that's built on hidden trades and dark pools. Speaking of dark pools, AMC continues to see 62% of its trades routed off exchange, meaning price discovery is constantly suppressed. It's not conspiracy, it's data. These off-exchange transactions delay and distort AMC's true market value. Still, the fundamentals speak louder than ever. As investor Degen Life pointed out, why wouldn't someone buy a company that owns the largest number of movie screens worldwide, carries one of the most loyal shareholder bases in the market, pays off debt steadily, and continues to add new revenue streams, all while trading at around $3 per share? That sounds like an undervalued gem in plain sight. And if that $3 company keeps improving, cutting debt, boosting profits, expanding distribution, innovating with AI, yet the price doesn't reflect those gains, what would you call it? Most would agree, undervalued. AMC's long-term story has been misunderstood for years, but the math doesn't lie. Value has been suppressed by dark pool activity and synthetic pressure. Yet fundamentals and retail conviction continue to strengthen. Now let's move to the latest chaos, broker instability. GameStop's new warrants have exposed cracks in the financial infrastructure once again. According to reports from X-Market News, GameStop shareholders have reported inconsistencies in warrant deliveries from major brokers like Robinhood, Fidelity, and Schwab. These are not small names. These are the same platforms that faced scrutiny during the meme stock events of 2021. And once again, technical issues seem to surface whenever the topic is AMC or GME. Coincidence? Hardly. Another report from Boss Blunts reveals that E-Trade is now facing similar system failures, with brokers going offline for users. These are supposed to be straightforward transactions, yet they're breaking systems. Why? Because these firms are over-leveraged and struggling to reconcile the number of real shares versus synthetic ones created in the system. When brokers promise more shares than actually exist, chaos follows. They're now being forced to match real shares to warrant obligations, and when they can't, it exposes how deep the synthetic problem runs. This is the same underlying weakness that AMC investors have been talking about for years. It's the crack in the system that could eventually force a reckoning and possibly a recall of shorted shares. When that happens, the buyback pressure won't be gradual. It'll be violent, because every missing share must be accounted for and every position must be closed. So where does that leave AMC right now? In a position that's stronger than it looks. The fundamentals are improving. The box office is booming, institutional interest is growing, and broker instability is showing signs that the system's foundation is weakening. All it takes is one catalyst, one institution deciding to flip the switch, and the entire short thesis could collapse overnight. AMC isn't just a theater company anymore. It's a symbol of endurance, innovation, and resistance. Whether you're holding or watching, understand this: the story isn't over. The groundwork is being built quietly, and when it all comes together, The result could rewrite what Wall Street thought it knew about short squeezes and retail power. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Before ending the video, I want to say one important thing. If you have watched the video till this point, it means you are among those who are true AMC supporters. And for supporters like you, we have created a Facebook group. You'll find the link below. Join the group and become a part of our community. Also, for our community members, we have a PDF book inside the group that explains how to do stock analysis. After reading it, you will become an expert in fundamental analysis. Thank you for watching.